Right, welcome to a run through of the top 5 charts of the week. This is the free weekly email that goes out to the subscribers of the website. Now, we'll start off with number 1 here, and this is called what I call the stay or go indicator. This is an indicator that I've built or designed from the Atlanta Fed data. So the Atlanta Fed, they're quite an interesting, innovative bunch over there in the economics team. They've designed a few different kinds of indicators like this, and this one here is the wage growth tracker. And there's a few different sort of subsets of it, and one of those subsets is called job switchers. And this is people who have changed jobs, I believe, in the last year, and the job stayers are the ones who've stayed in the job for at least the last year. So basically it's people who are either switching the jobs or staying in the jobs, and I've taken here the stay or go indicators, the spread between them. And you'll notice here that the pace of wage growth for those who are switching jobs is materially faster than that for those who are staying in their jobs. And this is normally the case, so this spread has actually, throughout the period that it's been calculated, has never actually gone below zero. It got pretty close in 2009, and that should give you a pretty good clue about how to read this indicator or what kind of information it has. At the moment it's at a 15-year high, and what causes this indicator to be higher is when employees have better bargaining power. So what kind of conditions would employees have better bargaining power? When the labour market is hot. So if the market rate is generally higher than the rate that existing employees are being paid, then it pays to switch jobs to get the pay increase faster. Most employers probably put their pay increases through on an annual basis, through some sort of system. So it's this indicator is going to surge when the job market is particularly hot, when wage growth is about to accelerate. And actually, on the flip side, it's going to contract when people who are switching jobs for whatever reason have to just take whatever they can get. And we saw that in the lead up to the financial crisis. So it actually started falling in 2007 and gave slight lead on the contraction there. So it gives a slight lead. It's quite an interesting indicator. It just gives you another view on the pace of wage growth, or the hotness of the labour market, and whatever indicators you look at the moment. The US labour market is running pretty tight, and wage growth is expected to pick up from here, and that's going to reinforce the inflation dynamics, and it just means the Fed is going to be just more of the same, more rate hikes, and a continuation of its quantitative tightening plan. So moving on to the next one, the US earnings macro pulse. Now, needs a little bit of explanation first before we start interpreting it. This chart in the blue line is the nominal surprise index, and this is a combination of the both indexes are from Citi. It used to be called Citibank or Citigroup, and it's a combination of the economic surprise index and the inflation surprise index. Now these indexes are a composite, or they calculate basically how the data is turning out versus expectations. And so if expectations are too low, or just if expectations are normal and the data comes out sort of either normal or above expectations, then that's going to make this indicator start to look better. And if the data is falling below expectations, or expectations are too high, then the data is going to turn out below it. You can see there that it's running at a pretty decent pace after being relatively suppressed for quite a number of years there in the post-crisis period. 2015 was particularly bad, and that's around when we saw the stock market corrections back there. And the reason why I highlight that is that now stands in contrast to that. And of course you want to also look at the black line there, which is earnings revisions indicator, or earnings revisions momentum indicator, and that combines the earnings revisions ratio of revisions up to down, and the pace of change in the forward earnings. And really that's just telling you the momentum of forward earnings revisions, and it's going at a pretty good pace. So, you look at this chart in the context of the correction, the market troubles that we're having, and you'd think that, it's probably not that much of a concern. Well, certainly in contrast to 2015-16 when it was on the wrong side of zero. Speaking of fundamentals or earnings in general, you've got here, this is the fundamental sentiment chart from the weekly survey that I run on Twitter. And the black line or the dark line there, it's equities fundamental sentiment, net bullish sentiment, and you can see there that's it sort of switched over to the bullish side late last year after turning up from about June last year. And for most of that time, bond market fundamental sentiment had been moving roughly at the same pace, same direction. And note, I have actually inverted the bond sentiment indicator because, basically if the economy is getting better, growth and inflation's picking up, that's usually good for equities and it's usually bad for bonds. And so having that bond fundamentals sentiment indicator actually turn up, so it's actually becoming slightly more bullish, would imply that the bond guys are thinking that the economic outlook is actually worsening, whereas the equity guys are sort of thinking it's still pretty good. So it's an interesting divergence here. You always want to keep an eye on those divergences because they can carry a bit of information. If we're looking at the same thing, if by fundamentals we mean the macro outlook, then one of these groups is going to be wrong. If it's the bond guys, then that means we're probably going to see another leg up in bond yields. If it's the equity ones, then going back to that previous chart, it would imply that we're going to see that roll over and more difficult times for equities. My bias would be to expect that the bond ones are probably short-term wrong on this one, but we'll have to watch and wait and look at the data, see how that folds out. Next one, number 4, is the CBOE implied correlation index. Now this one is a kind of an interesting indicator. It's similar to the VIX because it uses option prices to derive it. And it's also similar to the VIX because it seems to be giving these kind of contrarian signals. And on that note, I have actually inverted the line there so that it's sort of in line with the signal that it seems to be generating. Seems that lower correlations, which would be a higher reading on this chart because it's inverted, seem to line up with short-term market tops, and spikes and correlations, which is going down because it's inverted again, would seem to be indicating short-term market bottoms. So if you think about that as the framework for the signal in this indicator, and then it looks to be generating a slight buy signal at the moment, short-term buy signal, which is interesting, and seems that we have seen a bottom there. And, it could be famous last words, but I think that this correction's over now. We've got a few indicators like this lining up, and especially you look back at that earnings economics pulse there, it seems pretty good at this point. But moving into the last one, investor cash allocations. One sign that we are towards the end of the cycle. Investors look fairly fully invested, or at least against historical ranges here. Just a quick explanation about the chart. In the red line, it is ICI Funds, Investment Company Institute, implied allocation. So it's money market mutual funds asset under management divided by total mutual fund asset under management. And the AAII survey, it's just a survey of investors' portfolio allocations. See that the red one's at a record low, the black one's at a cycle low. And that tells you, yeah, I guess that investors appear to be pretty fully invested. I would note that they're about, they're around 15%, just a bit over 15%. So technically, if you were completely fully invested, you'd have zero cash and just be all in. I don't think that we'd ever get to that scenario, but certainly would raise some eyebrows if we did. But anyway, this is the type of condition that you see towards the end of the cycle. The thing that you see towards the start of the cycle is, elevated or a rise in cash allocations. Like in early 2002, 2003, we saw that. Same in 2008, 2009. And, part of it is simply due to drift in allocations, so the market actually drifting investors there. Sometimes it's not necessarily a active decision, and you get that if if your stock holdings fall and your cash holdings remain constant, that just changes the weighting just by maths, right? But there's almost certainly a active decision that's also being at least partly imputed on that. So that is number 5, and that's the 5 charts of the week. If you had any comments, complaints, or any suggestions, go ahead and put them into the YouTube comment section below. And if you want to receive this email in your inbox every week, it usually goes out on Tuesday or Wednesday, I'll put the subscribe link in the description of the video. Otherwise, go to, you can see there, topdowncharts.com. Google top down charts, you'll probably find it, and you'll find the sign up box on the website. So thanks for watching.